All right, welcome back to Wook Capital Management's weekly Wook and Review. I'm Managing Director Rod Alsman. We're here for our 54th edition of our weekly recap on what's happening in markets latest week. I'm screen sharing in the Stages channel of the GME DD Discord server. So if anyone is joining via Discord, you can submit any comments or questions via the chat feature in there. If you don't want to chime in to the Spaces audio. All right, Joe, you want to read our little disclaimer then, and I'll jump in?
Yeah, let's get started here. Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. So while Rod gets started here, I'd like to note we do have pinned in the nest the Twitter thread. So if you are not subscribed to our newsletter, we still publish our weekly updates here on Twitter, so you can follow along via the thread there. You can also go to newsletter.wook.gg. We host these calls every Friday at the close. So come around next week, we'll have another one for you. We also do our open mics over on @GMEDD every Wednesday at 7 p.m. Eastern.
All right, thank you, Joe. So going into the material, which again you can access by clicking the little newspaper icon in the Wook Capital profile here. Obviously, it's also on your screen if you're following along, and Joe has it pinned. So the first story, touching on LUCID. LUCID started to deliver its top-of-the-line LUCID Air Sapphire, which they're just touting is the world's first fully electric luxury super sports sedan, whatever that means. I guess it's a brand new category that they're making up. Therefore, it's the first. So the interesting kind of useless factoid of this vehicle is that it can go 0 to 60 in 1.89 seconds, which is a whole tenth of a second faster than Tesla's Model S Plaid. When a law-abiding consumer is going to be able to experience that safely, I'm not sure, but it's something that people like to talk about. So very powerful vehicle, over 1,200 horsepower and 1,400 pound-feet of torque from the tri-motor drivetrain that I know we talked about Lucid in the past, and my notion was that their electric motor technology was toward the front of the pack. So the ability to achieve that sort of 0 to 60, I guess, speaks to the electric motors that they've got on the Sapphire, which starts out at the low price of $250,000 before taxes and fees. So if you really feel the need for speed, perhaps, and if you have a lot of money, the Lucid Air Sapphire might be the 0 to 60 for you. But
yeah, what's the MSRP on a Model S Plaid? Because it seems like it's almost double for 1/10 of a second faster. I believe I'm looking it up. Yeah, you can starts over 89,000. So is somebody really willing to pay nearly 3 times as much for? Essentially, the sales pitch is you don't want to be seen in the Tesla because it looks too much like the Model 3, and the Model 3 is cheap in budget. So I think that's really the sales pitch of the Lucid, is a more prestigious electric car.
so the Model S Plaid, yeah, starts at 90,000 is what I'm seeing. I mean, look, most people aren't buying cars to get the lowest total cost of ownership, even though I talk about that a lot when thinking about it from a commercial fleet perspective, because that's the only thing commercial fleets care about. consumers obviously care about different bells and whistles, and they care about brands, unlike commercial businesses. So, yeah, I mean, I don't know who the target audience is for a $250,000 super sports sedan. Presumably, Lucid has done some market segmentation analysis and believes that it's there. I mean, broadly, the premiumization is a theme that the OEMs have largely leaned into. Mercedes-Benz, that's been their stated strategy for some time now, is that we're going to improve margins by leaning into luxury because we can generate higher EBIT margins by pursuing that. Fewer kind of entry level, Mercedes, more higher end Mercedes. So Lucid's obviously a very different beast than Mercedes, but yeah, tangential to this because it's obviously not something that we put in. So Joe had put. I'll switch straight to the last story in the newsletter, which is talking about the trucking market, because I'll dovetail it with. We got the e-Actros announced earlier this week, which, if people forget, the Daimler truck is a massive global truck maker that used to be owned in full by Mercedes-Benz, by Daimler, but they've spun it off. It's its own separately traded entity now, even though I believe Mercedes still has a pretty large ownership stake in it. But regardless, there we go. I was looking for this. So there's the story that Joe linked, and there's the e-Actros. So I'll talk about e-Actros for a second, because again, fleets don't care about the 0 to 60 times insofar that it's not something that matters so much for getting work done. So Mercedes-Benz trucks, e-Actros 600 is going to be into production late next year in Europe. This is a class, what we would call Class 8 here in the U.S. Tractor that's going to haul trailing capacity. This is 600 because they're German. That's kilowatt. Not because they're German. That's 600 kilowatt hours. So that's going to be usable range of a bit over 300 miles. So from an efficiency perspective, we're talking about the vehicle consuming just under 2 kilowatt hours per mile. The Tesla Semi, from what I've seen reported, is a bit more efficient than that. It's around under 1.8. So let's call it 10% more efficient across the system, give or take. It's not a massive spread, but more efficiency, at least in terms of how many miles you're going to get out of that pack. This is going to be 311 miles of range. If you think about it, that can cover a lot of routes, but Europe is a different market than the United States is in terms of how compact Europe is for trucking. There's a lot more long haul trucking routes in North America and the United States that go far beyond that sort of a mileage. And just inherently, Europe is better positioned from a regulatory perspective as well as from an infrastructure. It's going to be easier to build out the necessary infrastructure given the density of Europe. So, but the one thing to remember, and it was not in this article, it's in a separate article, is that the upfront purchase price of this electric truck is about twice that of the purchase price of the diesel truck. So all of this comes down to the total cost of ownership, where you have to factor your CapEx, your operating expenses, and then your residual value in conjunction with what's your cost of capital to figure out what is going to provide you with the lowest cost means of servicing your customers. So even if we assume that the e-Actros can fully service customers with the same uptime as the regular Actros, or what is the best-selling tractor in North America, which is the Freightliner, which is a Daimler Trucks North America brand, Freightliner Cascadia. you got to defray a lot of upfront premium, which as interest rates keep rising, that means that your payback, those out year cash flows of operating cost savings becomes worth a bit less, and that higher capex up front becomes a bit more daunting in a higher interest rate environment. So all that to say, it's the continuation of what we've heard out of Mercedes for many years now about this long-term commitment to electrification and to carbon neutrality. They, I remember in 2019 when they rolled out their, carbon neutral by 2039, so 20 years. I'm quite confident that won't be achieved. It's just not possible, but companies continue sticking to these impossible targets for a variety of reasons. But yeah, look, just from what Freightliner themselves even expect, they're talking about 30% of medium and heavy duty trucks by 2030 being battery electric, which how much of that truthfully is being driven by the market versus driven by regulators. I would contend it's mostly by regulators. All of the companies that have announced they're going to use these vehicles are large companies that have ESG implications. One of the things at Ryder that was very clear was that none of the small and mid-sized fleets were going to be early into this. It's not worth it to them to risk their business, to taking on this new risk of a different type of operating asset. They will be laggards in adoption for sure. So the stuff that we keep seeing in headlines is, your Walmarts, your Werners, your other big private fleets and public fleets saying that we're going to test this out, try this out, etc. But a big question mark just remains: what's the thing worth? I thought it was interesting the way they structured the eActros, that it will be lithium iron phosphate battery packs. So that's going to be a CATL sourced battery pack, or at least CATL cells, because that's who they've had the relationship with for some time. They expect about 750,000 miles of operating life for those batteries, that 600 kilowatt hour pack, which they see it as that there will, it looks like from the, again, this is not in production yet, they expect the trucks will effectively have a first pack life running, let's call it about 7 years. Again, depending on how these trucks are used, every truck's a little bit different. You could have a tractor, a day cab that's putting 120,000 miles a year on it. I remember pricing deals at Ryder where that's not unusual, but on other cases, the mileage being used is a lot less than that. So the thing with the math for all of the electric trucks and anyone trying to make a total cost of ownership argument is that, yes, you're willing to absorb the higher capex because you have markedly lower operating expenses, and you believe that you're going to get value out of it. The end though is kind of a question mark for me, because having seen how the used truck market works, it's very much a price sensitive market. The people buying used trucks are buying them because they can't buy new trucks. So I don't know who the buyer of an eActros in 2031 with 80% of its battery life left is going to be. When we talk to banks, OEMs, really everyone across the space, I remember people coming to us and asking us what we thought. And we're like, nobody knows. Nobody knows what the residual value on these is. And it's a very large cash flow, even though it might be in year 5, 6, 7, whatever. On a diesel tractor, you're looking for a residual of, say, 20 to 25% of the upfront investment in, let's call it year 7 for Ryder disposing of that asset. Well, okay, so let's just do simple rounded numbers. We're talking about 150,000 ish for the diesel variant. Let's call it 300,000 for the electric variant. You can't just assume that you're going to use that same percent for electric. Ryder did that with natural gas, which that technology came in vogue after the kind of engine emissions rules came out, in 2010. So you had natural gas kind of become a very popular alternative for a brief time there, and Ryder priced those at the same percent residual value that it did for diesel. And those natural gas units were far and away worse in terms of the realized residuals. So I think that anyone who tests new technology knows that the first batches are usually not that impressive. And the question of who bears the residual risk, is it going to be Daimler? Is it going to be the fleet that buys the truck? It's going to be the financing entity that provides the capital to the buyer. A lot more questions than answers, I guess. So to bring it back then to transport today, as opposed to this world of potential transport years from now, you got Morgan Stanley's third quarter shipper survey that came in earlier this week. Ravi Shankar is the Morgan Stanley sell-side analyst. I've followed Ravi for years now. And the survey data that they got from shippers was kind of a mixed bag. I mean, they see that excess inventories have largely been purged, but there's not really a need to immediately restock. It was one of the lowest overall views on the economy from shippers during the 20-year data set. It was a 4.9, where in the entirety of the 20 years of the data set, the high is 7.7, the low is 4.2. So not off the all-time low. Retail shippers, a bit more constructive, which is good. Retail, kind of the retail bullwhip effect has been something I've discussed, and I think everyone's well aware of what happened and how much it rippled through a variety of industries over the last 2 or 3 years. So it's decent news, but still, people aren't exactly going at. So it remains to be seen how strong the consumer shows up, I think, through this quarter, and how that will feed through informing what sort of restocking, for ongoing activity into 24 these companies feel they need. It's one thing to say the bottom is in rates, which it might be on the spot side, but another point I think I've mentioned in our discussions in the past is that there's still a very wide negative spread between spot truckload rates, where if I need a 53-foot dry van to carry a load for me from A to B, I'm going to go to the spot market. Whereas a lot of that freight, most of that freight, 80+% of all freight is going to operate under contracts as opposed to in the spot market. So the contract rates are still far above spot rates. And if you just think about it, spot rates will lead contract rates. So just like spot rates went to the moon, dragging contract rates up in 21 and first half 22, spot rates have cratered, and contract rates have not cratered. Contract rates have been much stickier. It took the elevator up, and it's taken the stairs down. So there's, I think, still expectations. You see it. I saw one of Bloomberg's notes this morning noting that maybe there'll be some upward pressure on truckload rates because of how low water levels are. On the Mississippi, that certain barge traffic is going to get rerouted to on-highway truckload freight movements. You have little marginal stuff like that here and there, but I think really it comes down to how strong is the consumer going through holiday to justify the need for retailers to restock. It's like it's going to get better eventually, but it's still going to, I think, for at least contract freight rates, going to get worse for another couple of quarters, just because spot rates are so far below contract rates. So there's all that on freight. Joe, I just talked for a while.
Rod, I knew when I put this story in, that was what we were signing up for.
Yeah, I mean,
I can go ahead.
One other thing, I think I've said it before. I'm still utterly dumbstruck by how resilient and richly valued many transportation and logistics companies remain. Like, you've got XPO, which is one of the largest less than truckload carriers, that is, trading like trading like a technology company. If you can see my screen, you can see like, and this is a company whose margin profile has changed markedly post pandemic, but these aren't these aren't the best businesses in the world, and the fact that we've got an XPO trading, at least on a next 12-month earnings, somewhat roughly the same as Apple, um, I would fade that all day. So I know, yeah, the LTL industry is structurally seeing some changes and it's continuing to consolidate, and the return profiles of these businesses will likely be better than they were pre-COVID. However, the valuations have just expanded like crazy, and um, yeah, I'm looking forward to seeing a lot of pain flow through the transports before I want to be a buyer personally. Um,
I'll go ahead with the SBF story. I'm sure you don't really care for that one, so I'll
I only
take it.
care for him getting locked up. I haven't really been
Yeah.
following that closely.
Yeah, I haven't either, but I see a whole lot of it on my timeline. I think people really are fascinated with Caroline Ellison giving the testimony, and so far everything she's said about Sam, Sam Bankman-Fried, has been pretty meme worthy. A lot of the stuff saying that he was a believer that he could be the president someday. He thought there's a 5% chance he could become the president, and he he at one point tried to use prostitutes' identities to unlock frozen funds from the Chinese government. He there's all these crazy things that he that he followed through, like his hair, being a mess. That was obviously a conscious decision. Sam Caroline said he thought his hair was very valuable, and that his unkempt head of hair was valuable to him and FTX financially. I believe that he had gotten higher bonuses because of his hair, and it was an important part of FTX's narrative and image. But yeah, there's a whole lot of crazy, crazy testimony coming out, and it's all still developing. Obviously, trying to use prostitutes' identities to unlock frozen funds. Over $1 billion in Alameda funds were frozen on Chinese crypto exchange during a money laundering investigation, and Bankman allegedly approved a $150 million bribe to Chinese government officials. So, yeah, but before resorting to the bribe, they tried to use some identities of which were not theirs. So, a whole lot of interesting things coming out here. To me, it's just baffling that some of the world's wealthiest individuals believed in this guy and didn't see it through.
Well,
Like
I don't know that I
personally,
would
I
call
had
it
never.
baffling. I mean, I think it just speaks to how we can all be deluded, right? We can all be fooled by randomness. You had, what was it, Sequoia, who was touting everything about SBF favorably, and they're not stupid people, but I think we all were probably sipping, too much on the hopium and wanting to believe in these things, and that this, guy's, oh, I'm an effective altruist and I'm going to do all these good things. Okay, we there was just too much capital that had no price to it, that everybody could promise rainbows and butterflies to infinity and beyond. So I hope he gets what's due. I mean, I hope he sits in a jail cell for a long time. I don't know what the outcome of the case is going to be. Clearly, I don't want to say that the people like Caroline and the others are guiltless. And clearly, they've opted to cooperate with authorities and provide their testimony in exchange for some sort of leniency. That's just how the criminal justice system works. But yeah, it's just baffling. Look, a lot of people were fooled. A lot of smart people were fooled. Um, and yeah, it's one thing to say, yeah, with hindsight, we all should have known it. But yeah, I guess the Matt Levin interview where he referred to it being basically being a Ponzi. Maybe that should have been the point to pull the ripcord.
Yeah, I mean it's easy to say in retrospect, but I do think had I ever even known about FTX or Sam, I never really followed FTX closely at all. I had known it was a crypto exchange, but I never looked into it at all. I think that the writing is pretty obvious on that one. It is, you know, it is shocking to me at least that this many people were fooled. I understand that the nature of a Ponzi scheme and how people can get wrapped up without knowing, but it is definitely shocking to me that it got this big. You know, this guy was like Tom Brady's best friend. This weird situation. Looking forward to
The
seeing,
Tom Brady
what
laser
happens
eyes
to him.
were pretty close to the top, if I remember correctly.
Yeah, that was pretty obvious. That's a retrospect. Tom Brady doing that was pretty obvious at that point. But definitely looking forward to seeing how this unfolds.
Yep. The only other item we had, I guess we got two other items. I'll be very brief on one, and then I'll skim through the other, so we can let whoever wants to chime in on those or any other topics come up. So there was the look. We didn't include anything on the Middle East in the story, um, but it's just sad, no matter how you slice it. Innocent lives lost. It's quite horrific what we've been seeing and hearing, and my only hope is that innocents are left out of it to the extent they can be. But in energy markets, you had a big uptick. You have a lot of volatility in the last month. You had markets run all the way up late September, to the mid 90s, um, crash back down in a week toward 80, and now today, crude was up about 6%. You've got things seemingly escalating in the Middle East further, so none of us know what's going to happen there. But that kind of drove energy higher. And this week, you got a pretty huge deal, biggest deal of the year, one of the biggest deals ever. Exxon agreeing to buy Pioneer. So Exxon is going to spend nearly 60 billion to acquire Pioneer Natural Resources, the largest oil and gas deal of the last 2 decades. So it was only a 7% premium to Pioneer's market value, but it's going to give Exxon a lot of assets, especially in kind of the Permian, West Texas area from Pioneer. It's their biggest deal since the Mobil merger, and obviously the biggest one of this year. So it's interesting in that now 45% of Exxon's barrels net of the deal will come from the U.S. And I feel like people don't appreciate it. And I'm glad you put the graphic in there, just showing how much production is actually coming from the U.S. And 15 years ago, if you think about what the chart looked like during the GFC era, and maybe people thought U.S. energy production, and oil and gas production was going the way of the dodo, but the fracking revolution changed all that. It's been a bumpy ride. There's a lot that happened along the way, but clearly Exxon being willing to commit to domestic production speaks to confidence that demand will be there for fossil energy products. That they feel good about the price and their ability to generate returns on those assets. So a lot of these energy companies, we talked about it a month or so back, have just incredible balance sheets that have, they've just printed cash and they've delevered. Many of them, Exxon has a huge net cash position, so going out using the cash to put it to work, acquiring these assets where it feels like is a good price. Yeah, we'll see. We'll see how it pans out. But definitely a lot of noise in the energy markets right now. What with the Middle East, as well as just some consolidation seemingly being the name of the game. And then lastly was actually, we can probably end on, a lot of banks started to report earnings this morning. I haven't gone through all of them. In a nutshell, we're still at that point where it's relatively smooth sailing. Like the consumer, I think Dimon CEO, JPM CEO Jamie Dimon, basically said they're not seeing, the consumer, degrading or deteriorating just yet. But that's where I think everyone is at. We're expecting what's going to happen, in this fourth quarter with the incremental headwinds we've talked about for some time now. And then you got the survey data from the University of Michigan that came out earlier in the day that I guess really put a damper on folks. You had big month-over-month declines in the index of consumer sentiment. It was down 7.5%. Current economic conditions down 6.5%, and future consumer expectations down 8%. So, yeah, I mean, look, it's clearly there's been some deterioration on the consumer. Some of the credit card data showing that. The banks, obviously, in the third quarter, not really seeing that, but eventually one has to think that if the consumer surveys are, deteriorating, the consumer feels less good, it will spend less, they will spend less. But for the time being, it's largely held up. So it's really, this fourth quarter that we're in now is going to be really informative to what happens. But obviously, it was a rough day out there for some parts of the market. I already mentioned energy, which ended up 2.2%. Utilities, which had gotten absolutely throttled, had a pretty good day, which I haven't even looked at rate markets. Yields must have come in, which is why utilities did better today. So they did. But technology had a really rough day, down 1.4 as a sector, and Nasdaq underperforming the other major indices. So, VIX though just shy of 20% to close the day, I think is the interesting one. I saw people prognosticating about the notion that either there needs to be more of a sell-off, on Monday as a continuation of this, or VIX is going to need to compress pretty rapidly. So we'll see what plays out. And then one other comment, I'd seen this graphic that I had retweeted. We've talked about it, but it's just stunning to see how enormous the spread between the Nasdaq 100 and the Russell 2000 is, and we can hem and haw about whether the Russell 2000 is the right one. And I prefer the S&P 600 to the Russell 2000 because there's a lot of profitless dog shit that sits in the Russell 2000 that is not in the S&P 600. But either way, it's still the same story that really, since COVID hit, you just had the huge uptick in the value of the large versus the small, that is now surged way into all-time highs of the ratio of the the Nasdaq 100 to Russell 2000. It's almost to 9-to-1 ratio. It used to be 1-to-1 in 1990. It was, let's call it 3-to-1 a decade ago. So it's, again, it's just the outlook, right? The current priced expectations, that's what the market is, right? Currently pricing expectations very dismally for small caps. There are reasons: cost of debt rising, the types of debt that those small caps bear relative to large caps. There are justifiable reasons for the spread to have widened, but it's a little incongruous because it basically says that small caps will experience a GFC-esque recession, while large caps will be immune to that and will continue to grow profits, in double-digit rates, which doesn't seem possible. Perhaps it will play out that way, but again, just the large to small spread blowing out further, making new all-time highs in the last week or two, as small caps have just gone absolutely through the floor. But yeah, that's all I had prepared to say. If anybody wants to request to speak, chime in. If you want to push back on anything or share your thoughts on anything we didn't touch on, we welcome that. It's about 4:40 here on the East Coast. So yeah, Joe, what else? What did I miss while we wait to see who comes on up?
Not much. Yeah, I didn't really include any story about the Middle East, of course. I guess I'd say on behalf of Rod and I, we offer a ton of condolences to everyone involved. It's a crazy, unfortunate situation. Besides that, we haven't really missed too much this week. It's been a pretty pretty mild week. We've tried to cover as much as we can with the Wook in review here. We did our weekly open mic series along with Logical Thesis this week, so that was fun to co-host with a big panel. Of course, you can catch the replay on his account at Logical Thesis. Hopefully, this upcoming open mic this Wednesday, we'll have another fun one and get a ton of our usuals there and have a good conversation. Of course, that's at 7 p.m.
Hey, Montiv, always nice to hear from you. Hope you're having a good day so far.
Well, good for my portfolio because I'm in the right places also. But, pretty horrible week and, well, for humanity, I suppose. So, I don't know. I feel very conflicted about what's going on. Really, there's no choice for Israel but to respond. But how far they go is going to probably make things worse, possibly, before things settle down. I don't know. I mean, today for me, the entire sell off was more about de risking over the weekend rather than anything else because the economic data is improving, at least for the immediate, few months. Outlook is pretty good. Earnings and the commentary from banks is pretty good. So this sell off was purely about not being caught flat-footed again over this week. This weekend, like last weekend. I think people just took the chips off the table to see what happens, and all the reports coming out are they are already starting to make some initial ground movement into Gaza. So things are going to get pretty hot over the weekend.
Yeah, it's there's no simple or easy answer or solution to anything related to the Middle East. The reality is that you had terrorist attacks on Israelis, and Israel is now countering that. And what exactly that counter looks like remains to be seen. I saw the reporting on Israel calling for people in northern Gaza to move out of that area. It logistically is, I don't know how that works. How you move 1 million people in 24 hours, and precisely what they're looking to achieve with that. But I mean, the geopolitical reality then is you have a lot of people who don't like Israel in the world, and you've got some kind of, you've got different willingness from Arab leaders to say if Israel does too much of this, then we're going to shut off the spigots of that natural resource. I think if it was Qatar or who talked about turning off the gas, but clearly the market saw the risk in energy to bid up energy assets. Even though who knows what's going to happen here in terms of will there be a large global impact? Is this going to be mostly localized to Gaza and Israel, or what?
Yeah, but by the way, that post about what the Qatar's emir said was debunked almost immediately, and they deleted
Okay.
the poster that said it. Somebody translated it and said it had really nothing to do with shutting off gas at all. So,
Okay.
but this is the problem: the misinformation station, right? So what do? You can't hold over the weekend when you have news like that could actually move the market. So you're better off just staying on the sideline and watching. For me, I don't have that choice. I don't have portfolio that are just that fast. So I either have to take the hit or be in the right place. I'm partially there, but I'm going to take a hit one way or the other if things go pear-shaped, right? So it's. I mean, look, if things don't really go off rails this weekend, and if the war, at least stays where it is, right, within Gaza for now, with some nuisance to deal with. You saw the statement from the defense secretary. He said, you know what, you take care of Gaza. We'll make sure Lebanon doesn't get involved. We'll make sure Hezbollah is going to stay quiet. So they brought A-10s over to the nearest air bases they have there outside of Israel. So they're already preparing to assist in every way possible to not let any other players think this was an opportunity to to come into play here. So as long as it stays within this, I think in a few days you're gonna, just like it happened during Ukraine. I think people are going to revert back to, okay, fine, we can keep one eye on this for a little bit, but move on with life. That's unfortunately what happens. I know it sounds heartless and cruel, but it's sort of how we dealt with Ukraine, back in early March last year. I mean, 2022. So we have some interesting earnings next week that will show. I mean, today JPM and Citi said investment banking business was better than last quarter, so that would be a good sign for Morgan and Goldman next week. Goldman, of course, finally got rid of their green skies, yeah, the consumer division, so they're probably going to take a loss on that, but it should be against better news from trading, from deal making, all of that. So next week should be fine in terms of earnings. And people forget one thing: the way the earnings are because of different weightages. It's not that surprising that quarter after quarter, the last 3 quarters straight, overall earnings have come in better than expectations, right? I'm talking purely against expectations, but that's a very simple mathematical is setup. It's nothing really that people can't figure out if they spend 5 minutes looking into the, under the hood. Basically, let me just make it very simple for people here. I'm sure you already know, Rod. So 19% of S&P earnings comes from tech. 17% comes from financials, 14% comes from healthcare, another 9% comes from energy. Okay, so this is your what does it work out to? Close to 60% from these four sectors. Now we know energy is going to do well because the expectations are pretty low and the prices ran up. So energy should be okay. We are already seeing the largest of the banks say that they're doing fine, and in fact, they have put away less for credit losses than they did last quarter. So, assuming the financials go the way, and again, right, we're talking about S&P 500 here, so only the larger ones, right? The smaller ones we know are going to have significant problems. So, as long as the mega tech come in around expectation or a little bit more, we're going to have another season of earnings beats. Now, that's a function purely of math and purely of setup, right? You bring the earnings estimates down far enough, yeah, it's easier to beat. But people have to understand this is not, people trade against that. So it doesn't matter what you think, why you think they beat. It only matters that it happened, and it happens rather easily. If you start separating the data even more, 7 companies account for 25% of S&P earnings, and those are actually surprisingly mostly Dow companies, right, including Chevron, Exxon, right? So it is not that difficult to beat earnings expectations, and that's a psychological, you know, um, kicker for trading. So There's a lot of reasons why it happens, and it's not difficult. It's accepting that there's no conspiracy behind it. It's just math.
What are you most looking for out of this earnings season, Monative?
Well, so let's see. Like I said, energy I think outperforms dramatically because the expectations are low compared to the same quarter last year. So and it's still supposed to be down a lot. I think that was priced in with
Yeah.
oil at
I'm looking at
July
the fact
prices.
sets 2023 energy 3Q year over year. It's on the earnings line, it's minus 23%
Yeah,
year over
exactly.
year.
Yeah,
Yeah.
so I think, and that's based on right July prices when they give guidance, right? So remember the mega cap energy, reports early in the day, so their guidance is based on prices at that time. So even if they get marginally more, they're going to beat that negative 23% very very
I
easily.
apologize. I was looking at the 4Q is the minus 23. 3Q
It's
is
like
minus 38.
yeah, so something like that, right? It's a little bit different in definitive, but roughly there's a dramatic underperformance expected from energy, and I think there's going to be a dramatic outperformance over expectations. So that's 9% of earnings, right? Of S&P earnings, and that's a handful of companies you're talking about. We're not even talking about the entire sector. And then you have communication services. Now, I've talked about this multiple times. Online advertising revenue is picking up steam fast for the rest of the year, and it's backloaded in the year. So I do expect Google and Facebook to comfortably hit their numbers, even if they don't beat by a massive margin. They're going to hit those numbers. Well, that's my expectation at least. So assuming that happens, that's half of communication services, right? XLC. So you have that, and then you take on Excel Y. It gets a little bit interesting. So Tesla and Amazon are the big players there. Now I will leave Tesla out of this because I really don't follow them. I really still don't understand how the company works or what they do to make their money. So I'll leave it out of the picture altogether. I just don't know. I just don't trade. Amazon has this waxing waning cycles of investment, both OPEX and CAPEX. We are now in the waning cycle of that. So this is
Yeah.
throughout their history. It's been like this. They spend about 5-6 quarters, and then they cut back to the bone for 3-4 quarters, and then they spend again. So the margin on the retail side goes anywhere from 3 to 8%, right? We are at 5.4% there. I think it goes well over 6, and that's purely not it doesn't have to be anything else. It doesn't have to be that people are buying everything on the shelf. None of that. It's just cost control. But it's published numbers. It's what's expected. It's beating expectations, right? So it's again just simpler stuff to look at rather than deeply probing into why this happened, right? It doesn't matter. If they beat big, and they're expected to beat because this is again, like I said, the waning quarter of spending. So three drivers, right? They are number three in advertising. So Google is about 25% of online advertising. Meta is just under 21%, and Google is like 25 and a half, 26%, let's say. And Amazon is running third at 9%, and it's growing the fastest by a lot. So I think that is going to help them dramatically. They are going to make a lot of additional revenue and margin there. And the third piece is, the expectations for AWS this quarter are pretty low. They've been, the weakest growing of the three. Of course, they are by far the largest of the three. So as long as they don't worsen, it's not going to impact them negatively. So anyway, going back, right? So now you have Exxon, Chevron, you have, which are likely to beat by a mile, in my opinion. You have Google, Meta, likely to at least beat reasonably, in my opinion. You have Amazon, likely to probably beat pretty big, in my opinion. These account for a shit ton of S&P earning. So, again, right, it's math. If you look under the hood, it's whether the way we do this, whether the way we weight S&P is right or not is a whole different calculus, right? I'm not going to argue that it's right, but it is what we have, and people trade based on earnings against expectations. This is what happens. This is why people always end up being surprised. Oh, there's no way earnings are going to be good. And then you come and find out the earnings are better than expected because it's simple math. You have to understand what's under the hood rather than saying, hey, look around me, the economy sucks, earnings can't beat. Actually, the economy can suck terribly, and 6 companies or what, 15 companies is all it takes to make sure that the earnings beat. And people have to understand that before they trade anything more than intraday. These are mechanics of the market in earnings that move.
So I would agree that expectations and how things perform related to those is important. I guess the other piece of that though is the outlook and whether there's guidance or what that looks like. And I don't know that I've ever seen it more. I mean, not say I don't know if ever, because well, it's been an unclear last 3 years. But it seems like companies generally their expectations for 24 they don't have a good line of sight. Like I was saying with shipping and transport, even these companies really don't have a great sense for what the environment's going to be like. So it it will be helpful, I guess, to hear if any of these big players have a lot of confidence one direction or the other. I guess I'm not really holding my breath, though. I think that we need to see 4Q play out more, and people won't really go out on a limb for what they expect for 24 too much yet.
So, as unfortunate as things are, right? War is always a reason people can go back and say, you know what, hey, things are unsettled. We don't want to, we want to pull our guidance. So I fully expect a few companies to take advantage of that and say, you know what, we're going to pull guidance. So yeah, I don't think we're going to unsettle the unsettled, expectations for 24. Guidance is a whole different story. So, we don't know. The expectations for Q4 of this year are pretty high, actually. The earnings growth minus, earnings growth this quarter, I think, is only like 1.3% for S&P 500. If you take out, the extreme underperformance expected in energy, or at least the expectations are that it comes to like 6%. So that's the level of underperformance that energy is expected to push S&P into, which is why I think it's going to be an easy beat there. So the next quarter expectations are probably going to come down because right now the expectation is close to
It's almost
9%.
10% for
Correct.
4Q.
Correct, 9.3%. So yeah, it is probably, well, again, right? We could beat that just because of 25 companies beating that. So we don't know the story, right? Again, right, narrative overtakes all of this, but yeah, guidance is going to be where the interesting play is for any of the companies going forward. I've been saying more so than even last quarter, and I've been calling this as a year of guidance winners and almost nothing else, and it's happened that way. And I think it's even more so going forward because the expectations are pretty high. So do expect the analysts to start taking down guidance by a lot.
Right, you're right, because the expectations for 4Q is a huge jump from 3Q, which is pretty much flattish, I guess, depending on what you're excluding. And then 24 and 25 are both calling for 12% full year earnings growth, which is a very healthy rate of growth, like we've talked about. So, yeah, again, with how depressed some of the smaller company valuations have gotten, it's just like it seems like there's a disconnect there, and that to me, my view is that 12%, 24 and 25 S&P earnings growth comes down.
Yeah, almost certainly, right? That's going to come down. But then again, right? All they have to do is beat those expectations when they get lowered, and you're off to the races, right? Those do those do come down as you get closer, right? So, but based on this quarter's guide, people will also adjust Q1 Q1 expectations and Q4 expectations, of course. So I expect that. But another very interesting thread. I call this right after the war started. Market opened and there was some spaces, and I was on there, and I asked this question of a few people that were buying tech shares, and my thesis was very simple. Across the world, as long as you are a Israeli citizen, if you do not have a health, age, or a religious exemption, you serve. Period. There is no other excuse provided. So those are the only three exemptions as far as I know. So there's a lot of people that are already on their way back. I can tell you, I know people in the valley who are on the way back. Tech is filled with Israelis because of the skills they bring to the table, especially cybersecurity. So one of the questions I asked was, hey, has anybody, started thinking about what's the risk here if they lose staff for 2-3 months? I mean, I just mean lose it, going on extended leave of absence because they got, called back to serve. Even I don't even mean anything else, getting injured or worse, right? I don't even mean that. But a lot of people, an expected up to 400,000, okay, this is the theoretical max, okay? 400,000 people have been put on notice. LL is flying during Sabbath for the first time since the last 25 years, I think. And these are all trips to bring people back if they cannot come on their own. And there's a lot of people that can, and they're already making their way. Like I said, I know people in the valley personally that are either already on their way there or leaving this weekend. And lots of companies that I know are scrambling to adjust their HR policies to give them extended leave of absence, and figuring out how to deal with the consequences of that. So that's one part, right? That's across the world. So it's not anything specific to tech companies, though. There is a lot of tech talent from Israel. The other part is there's a lot of tech companies that have significant presence in Israel, and there are Israeli tech companies that are listed here that are favorites of traders, especially the growth stock traders, right? There's going to be an impact to all those companies, and nobody is well. I don't want to go into names of who it was, but he just brushed it off, and I was questioning him. He's like, "Oh, I'm gonna buy Monday. I think it's fallen and it's great. I'm gonna buy it." Like, Monday has 400 employees in Tel Aviv. I don't think they get an exemption for, you know, uh, software that's really nothing to do with anything useful for the military in any sense, or national security in any sense. these are things that are going to bite, and I think minimally. I mean, it's very possible that within the world of cybersecurity, you're going to have key man risks pop up. You've got your CTO or your primary designer get called back wherever they are deployed or in wait state. It doesn't matter what, they're not working, and there's a risk. So there's going to be a handful of companies with keyman risks too. And Rod, you and I have talked about keyman risks in other instances, but people don't even realize these things.
You mean what happens if, say, an Elon Musk disappears? What happens to your company's valuation?
Well, I think there's no risk of him serving anything anywhere, so that's less of a problem. But yeah, think about this, right?
Right.
Your
But that is a
primary.
really good point about cyber, and is a space I don't follow closely. I at least know just what you stated speaks true to me, that there are a lot of Israelis in the space, and what are the effects to your business of a lot of these individuals just getting plucked out of your workforce for who knows how long, if they ever come back.
Yeah, I mean, just the disruption is going to be massive, right? Sentinel-1 is an Israeli company. Monday.com is an Israeli company. Checkpoint is an Israeli company. Even assuming they have, let's be charitable, a third of their staff in Israel, that's a third that could get called. Look, this is impacting other companies too. Elbit Systems, which is a major defense contractor in Israel, it is the largest listed defense contractor in Israel, and they're very critical to this effort because they do a lot of munitions, guided and unguided. So the first gut reaction was it sold the heck off, almost 20-25%, from around 220 to all the way to 196. And I was talking to people that I work with in the defense space, and we all agreed that it was overdone, and they were almost certainly likely to get exemptions from serving just because of a national security need. But none of us were brave enough to take the trade, and sure enough, it's completely recovered. This is going to be a big deal if this doesn't resolve itself. If we start a ground assault and that expands and it sticks for more than a few sessions or days, there's going to be more and more people called, and more people meaning they are people that have to leave the seats that they're working in and go serve. And it's not just that they get called the day they are supposed to join. You're supposed to show up right now, start preparing, right? It's not like the Israeli army can afford to wait and call them when they need them. This is not a just in time thing. They're like, what, show up where we can pick you up from home, get your things in order, do this, that, and the other, and be ready to serve at a moment's notice. So which is why you see masses of people leaving the valley. There's like thousands and thousands leaving. I'll give you another example. Intel. I don't know what the impact to Intel is. I don't have a position. But Intel has, almost 12,700 people in Haifa in 5 sites. You think there's going to be at least 20-25% of them called? I think so. But I don't know when. Some of them could get exemptions, some of them maybe not. But these are things that are not being modeled for this quarter. Not in terms of what the impact is to the numbers, because it happened too late anyway. It happened outside the quarter. But in terms of what the callouts will be, what the risks will be called out during the quarter, the guidance, things like that, I think this is where the risks are, for tech at least.
I would reckon that tech's probably the most impacted of. I know Israeli contributors. There's probably some bio, but tech and bio, I don't know. But yeah, it'll be interesting to watch how this all plays out. You're right. There's these effects. The key man risk one stuff. It's hard to, if you can identify that in the moment before the market prices it. Um, that's an opportunity for you.
Yeah, and you have examples to go by recently. EPAM Systems. It's a consulting company that had a big presence in Russia and Ukraine. When that war started, I think it lost like 40-50% in a week. It slowly recovered, but then again, they had to move staff. They lost a lot of staff. They had to close some business, close a lot of offices. It's pretty disruptive. I think it's sort of the template that will follow, but this is a very different story. I mean, tech companies do have, the ability to fill those out with something else, but it will have an impact. Whether it's significant enough to put into earnings, I don't know, but I'm going to bet that there will be companies for which it is significant enough to be, a line item in the earnings call.
Good stuff, Monative. Paul, did you want to chime in on this, or?
Yeah, is he talking? Because I see his thing moving, but I can't hear him.
No, I see him muted.
Oh, weird. Maybe mine's on a delay. No, I was just gonna quickly say, like it's I'm pretty sure it's not a broad-based like reservist call-up, because there is a functioning monthly withstand. There's a lot of Israeli companies that like still need to function, right? Like you can't just pull a lot of people from like just certain areas to fill the void of needing bodies on the ground, right? But it's very interesting, which is I guess a testament to like national pride. So like one of my buddies works at a tech company, which is Israeli, and their HQ is in Tel Aviv, but they have obviously operations across the globe, New York City being one of them. And there's a lot of like Israeli expats here, and they're basically saying that after the attack happened, the government called him up because, as part of his service after high school, he was one of the fighter pilots in the Air Force. Granted, he lives here now with a family and kids, and the government called him up and was like, "Hey, I know like you're like halfway across the world, and you're not like in Israel anymore, but if you're willing to, we could really use more fighter pilots." And like without hesitation, the guy was just like, "Yeah," and so he left his wife and his kids behind to go back to Israel, and he's already been flying up in the air already. And mind you, this is in less than a week. So it's just kind of interesting that you got a lot of uh, Israeli nationals from all over the globe being contacted by the military, saying like asking them, "Hey, like, can you come back and serve?" And he's one of them, and he said yes. So I can only imagine how many other people have also said yes, but it's not without other companies, having to like obviously understand the situation and work around it.
Look, of course, it's not going to be everybody, and it's not going to be every company that's even impacted, right? And certainly, even among those impacted, there will be, possibility for most of them to mitigate that risk. But the risk is there, and it is a new risk, and there will be companies that are, more impacted than others, and that's what I'm talking about, is to, find out which of these is a greater risk to, either take out of your position or to build a position around that risk. So that was my point.
Yeah, but it's also like to what degree can you? I'm sorry, I'm like walking past these steps and whatnot. And so also like to what degree can you actually like apply weight to that though, right? Because you can, like you said, yeah, you like you mentioned Monday, 7:01, etc. But it's like there's there's probably going to be a lagging effect in that, right? But then also the time we also have like cloud cover with just the macro environment right now as well. So it's like, all right, well, maybe there's not as much work to do. Yeah, we have like less bodies, but spread the workload a bit. I mean, obviously it's on a case by case basis, and we'll never actually know to what degree that happens. But it's just something I think about.
Can anyone hear him? Did we just lose him?
Yeah, no, I heard him. Did you not hear Paul? He just
No,
chimed in.
did he? I guess he stopped talking. Then I thought he stopped mid-sentence. But look, I'm not calling out Monday specifically. I'm just saying, Monday is, has 400 people, at best I know, in Israel, and there's going to be a few of those called away. It's just an example. It's nothing more than that. I'm not saying there is a trade in Monday. I'm just saying for me that's a different list to watch rather than, and if I had a trade, I'd be hedging it. So if I was in one of those companies for my own risk tolerance level, that's what I would do. Again, everybody has to deal with it differently. I'm not by any stretch, repeat again, I am not saying any of this is a short based on, this possibility or this probability. At this point, it's already, happening. Like I said, I'm not suggesting there is any short here. I'm just saying that it is something I'm watching carefully, and if I have positions with exposure, I will be hedging. That's it.
Yeah, it's actually interesting to think about too, because like Fiverr is an Israeli company, but they like during the break of the Ukrainian war, they had a lot of devs in Ukraine um, that they kind of had to like navigate around since they weren't going to be around because they got called up too. Um, come on. Um, no, but yeah, no, I totally get it. No, we're on the same page.
Rod, if you can get Bill up, I think he listened to. I've not yet listened to the bank conference calls, but he did. He was posting about it. So if he wants to come up and talk, I'll be doing that later tonight and tomorrow. But if he wants to come up and talk, I'd love to hear what his thoughts are.
Yeah, I shot him an invite if he's able to. I'm sure probably similar to what we said earlier. Smooth sailing still for the banks, especially the big ones. Uh, but Bill, there he is. Have have at it.
Hey guys, what's happening?
Just want you to tell us how wonderful the banks are doing right now. Give us give us an update.
Well, I mean, I don't, I mean, expectations were pretty bombed out, right? Um, but none of them are really showing any. I mean, at least the ones I haven't gotten to all of the earnings yet. But I mean, the big banks were fine, all of them, right? Citi, Wells, J.P. Morgan. I'm currently looking at PNC. I guess there the only issue was just a little bit of an uptick on uh, non-performing loans, which they moved out of classified from last quarter. But other than that, I mean, everything looks fine. Like again, I think the basic story is, other than a little bit in CRE, there is really no credit stress, right? Like I flipped up the headline, what I thought was the headline from the J.P. Morgan call, where I think one of the analysts asked them, like, where are you seeing credit softness, either consumer or commercial? And by softness, I think he meant not loan volume, but credit issues, basically, right? Charge-offs or increased loan loss provisions. And I mean, basically, the CFO said, nowhere. We're not seeing any credit stress anywhere. In fact, they pulled down a lot of their loan loss reserves in this quarter, right, from last quarter. So again, I keep coming back to the same story. I think there is these cascading levels where the recession risk is just being taken off the table. And I think banks sell off when there's a big concern about recession risk. And I think, at least with the big banks, which are really important to the U.S. economy, I think they may be the last ones. Hopefully, the market will realize where the recession risk is being pulled off the table. Right, equities sort of wrote
Well,
recession risk
small
to
cap
zero in
equities
October.
are not writing recession risk anywhere near zero. So will small caps recover if recession gets taken off the table?
Well, I mean, yeah, it depends how you define small caps, but yeah, I would say small caps are still sort of unloved, but maybe they'll be the last ones. I don't know. But I mean, again, you got to be careful, right? If you're talking the Russell 2000, the Russell is not the same Russell that it was 10 years ago, right? And any small caps of any quality that used to be in the Russell have been taken over by private equity, right? What you have in Russell now is a lot of, you know, profitless, cash burning biopharmas. Like it's I would say the quality of the earnings in aggregate of the Russell 2000 has really deteriorated. So I'm not sure it's a good proxy anymore the
Yeah, I
way it
mean
used to be.
well, let's use the S&P 600 as at a 12 times PE versus a 18 for the 500. I mean, I
Right,
agree with
right.
you though. The
But
Russell 2000 is not a good,
the Russell's
not
kind
good.
of garbage now, yeah.
Yeah.
But having said that, you're right. I mean, I think there are bargains galore. I mean, again, I agree with you. I think there are some really good bargains out there if people are willing to pick through kind of and be careful in terms of their stock selection. But anyway, I think the banks are fine. I think the main risk that people are worried about is not materializing, and as we kind of leave March, further and further in the rearview mirror, it's going to turn out to be that it was sort of a one-off, right? It was kind of a series of very idiosyncratic banks that had a very high concentration of um, extremely large deposits in the hands of a very few individuals who all panicked at the same time and brought down those banks. But really, the shock waves kind of reverberated for a quarter or so, but there's nothing but ripples left in the pond now.
So, Bill, we get to March and BTFP just gets extended for another year and we sing Kumbaya and all is well.
Well, more importantly, bank reserves are 10% higher than they were just before, all hell broke loose in March, right? Like one of the indicators that I follow is, I mean, so the big picture is I keep using the same expression. I think the runway got foamed, to a large degree in March and April by both the Fed and the U.S. Treasury. In two ways, right? The Fed basically created these programs where they basically took mark-to-market risk of treasuries and MBS off the table because, anything you had before March 18th, you can borrow against from the Fed at par value. So it doesn't matter what the mark is, right? It's like you get 100 cents on the dollar. So any further mark-to-market risk on those kind of high-quality assets is irrelevant, right? Like it doesn't matter. It doesn't matter that your 30-year treasuries you might be holding might be at 70 cents. You can borrow the full dollar against them. So that's off the table. And then the second part that's off the table is the U.S. Treasury has come in with extremely large T-bill issuance, which has essentially blunted QT since March, right? Because what's happening is instead of it coming out of reserves as the Fed, normally in the absence of a big reverse repo program, as we saw kind of in 2018, 2019, as the Fed does QT, it basically removes reserves from the banking sector until such time as it gets to such a low level that it can't do any more QT, right? Which sometimes it doesn't even know until something breaks, like in September 2019. But in this case, what's happened is, everybody talks about this massive issuance of treasuries since the debt ceiling got taken off. But the reality is that massive issuance, like there isn't a big increase in 10-year issuance or 30-year issuance. It's all T-bills. And the effect of that is to basically blunt QT because it's all coming out of reverse repo now. So reserves have actually gone up. Like they were under 3 trillion before SVB blew up. They're now at 3.3 trillion as of, this Wednesday. So the banks are in kind of like bubble wrap right now, but thanks to the Fed and the US Treasury.
So the BTFP bubble wrap just keep them wrapped, keep extending that program? Because I would think there
Yeah,
would otherwise be a cliff if BTFP just went away. They can't do that.
right, right. But you got to remember, it's basically those programs have either flatlined or, in the case of other credit extensions, have sort of been diminished. And it's now turning out that most of that went into the rescue of things like First Republic, or, the reworking or the runoff of, SVB and Signature and all that, right? Like, the lion's share of that was for that March rescue of 3 or 4 banks. It really hasn't been needed by most banks, but it's there, so it helps. Anyway, I mean, the headline is, recession risk is off the table, as far as, JP Morgan even said, like, were forecasting, their baseline forecast for this year was a 2-quarter recession. They've taken that off the table and are now forecasting growth, limited growth, maybe 1 or 2%. I think they said 1% real, well into early 2024. So there you go. The bond market finally woke up, I guess, in September, that there are no rate cuts coming, because there is no recession coming. And now maybe the bank equities hopefully will feel some of that love, because the recession risk is being taken off the table, and the main risk to the banks being recession and credit losses is maybe not going to be as big as feared. We'll see.
So, Bill, I just had a question. Like, so did they talk, like, the headline said, like, JPM, they had like 35% jump in profits. Most of those, like, increase in profit, is it just due to the decrease in the loan reserves, or are they saying like loan growth or things like that?
I mean, I think they said tepid was the word they used for loan growth, which they sort of expect, right, given kind of where interest rates are and kind of what loan demand seems to be at the moment. So no, I mean, look, there's the core. I think the core is there. I mean, the really big banks also depend on, to a large degree, on their investment bank earnings as well. So that can be a bit volatile. But again, I think it's too early. These are the really big banks. I guess we'll get Bank of America next week, and then we'll see the parade of the very large regionals. To me, that's the more interesting one, right? The PNCs, U.S. Bank Corps, M&T banks. Those are sort of more the pure banks that I think will get a better read, both on the economy and also on sort of what stress. 2 quarters in now, what is the residual stress from kind of the SVB blow up that's still reverberating?
Bill, I don't want to put words in your mouth, but I remember M&T's one that you've been a fan of. Do you, and I'm just looking at still, if you believe that we're not going into an ugly recession, the numbers look pretty attractive. How do you feel about M&T?
I'm looking at it. I'm not a big, again, I'm going to say something here kind of shocking, I guess, but I only invest in banks when we are heading into like a real recession or real risk, right? Like a real economic contraction, because that's when, price to book values in banking really collapse. And that's just about the only time I'm really interested in them. But I do follow them just because I think they're more of a read-through to the economy. But yeah, I own one bank, but it is a very, very, very small bank. I think that's where, if you're comfortable, and it is not a easy sector to analyze, but if you're comfortable sort of analyzing banks, basically bank financials, there are some real gems in the very tiny banks, which have just been absolutely. I mean, they have a double whammy, right? They're banks and they're small, so they get both hate, right? The financial hate and the small cap hate.
Yeah, monitor before you chime in. I'm looking at M&T's graphic of price to tangible book, and it looks like it's on par with GFC trough right now at 1.3
So
times.
I took a small. I also like M&T a lot. Among the super regionals, I think they're the best of breed by a mile. I took a small position. I would have added this week, but with what happened in last Sunday, I decided to just leave it as one position. It's just that I don't know what's going to happen, right? I mean, it's not to me was not worth significantly expanding that position. It's okay if there is a run, post earnings, I'm fine giving that up. I have a very small position, so but I do like M&T. One other thing to Baron's comment: reversing reserves are just normal course of business. It's not anything bad in my opinion. It just happens. Those reserves are built out by the companies from their profits, and they take it down when they don't need it. And these days, they've been asked to hold more and more than they normally would since, ever since COVID, for sure, in this cycle. So, they are reversing if they don't need it, and that I see as more an indicator that their outlook is good, rather than that's where they got their profit from. That's profit they didn't recognize earlier. That's all it is for me.
Yeah, and the other thing you have to remember is, we're getting a bit into the weeds here, but the GAAP accounting for anticipated losses has changed since the pandemic started in March 2020. So now everybody has to use what they call CECL, current expected credit losses, which means, before you would just sort of look at your portfolio, you'd classify which loans looked, non-accrual or looked like they were stressed, and you'd sort of build a reserve against some percentage of that. Now you have to anticipate the lifetime losses on your entire loan book, right? The minute you originate the loans. So, you can imagine that creates more volatility, right? If for example, 2 quarters ago, we were thinking we were going into recession with high unemployment, the banks have to factor, they have these models, right, which regulators also kind of look at with them. And, if you're, the kind of lifetime losses you expect, if you're expecting, 4.5%, 5% unemployment in a 2-quarter recession, are, as you can imagine, very different than where we are now, where people are revising the forecast to no recession, right? And again, it has nothing to do with current non-performing loans. It is just a larger. It makes it for a much larger, much more volatile loan loss provision entry that it gets constantly revised every quarter. So you just have to expect that these are going to be volatile. There'll be quarters where they add significant provisions, and then there'll be other quarters where they reverse them because the assumptions have changed. But yeah, I mean, it wasn't just them. I think Wells Fargo also kind of took down some of their loan loss provisioning, I think. So again, consistent with, if you're not forecasting a recession, some of your assumptions become a little bit less onerous.
But wasn't last year Diamond, like he gave some comments which spooked the market. I think it was in Davos, if I remember correctly.
Yeah, didn't he say
hurricane or tornado? Yeah,
hurricanes,
the hurricane.
Yes. It was like the Dorothy and the Wizard of Oz, tornadoes and that kind of stuff. I think he just likes to be dark. And he thinks of himself as kind of the economy's chief risk officer, and he's like, what was it lately? He said, like, you expect 7% interest rates, right? And part of it is like the fun stuff about watching JP Morgan's presentations and stuff is part of it is they really don't like the regulatory apparatus they're under. So this presentation just had enormous pushback on some of the new Fed banking regulations that are coming in that are going to force them to carry even more capital. Like it was dripping through the entire presentation. Like, we do not agree. This is bullshit, basically.
There's something like 400 regulators sitting full-time in JP Morgan offices. It's just an insane number, how much they are under watch.
Yeah, and it doesn't really do anything, right? As we saw with SVB.
Well, it did for JP Morgan. They still, made a bunch of their money this quarter also from those, from those loans from SVB and other
Yeah,
First Republic.
I heard a good quote once that these regulators they're not really detectives, they're more like archaeologists. So they come in after the collapse of the civilization.
Yes.
Anyway, that's more to come next week. I think next week will be even more interesting with more of the mid-tier banks reporting, and I think we'll see a lot more volatility there. There's definitely some of those banks I think are going to have some pressure, so we'll see. And then there's some good banks that probably will shine. So you'll see, I think, a little bit more variation in kind of the outlooks.
Yep. Hey, thanks, Bill,
Bill,
for folks in the room. That Bill's an excellent follow. Especially he does write a lot about the state of the economy and especially things around CPI and PPI and stuff like that. So do follow him. The one other thing I want to before we switch to some other sector, Goldman washed their hands off Green Sky. They made a deal with some private equity firm to dump it. So it's possible they're going to take another loss this time, but that might be the terminal one. And given what we heard from Wells City and JP Morgan, investment banking side is doing better than they expected, better than last quarter. So it should help Goldman and Morgan, and Goldman might finally wash their losses out, kitchen sink this quarter, and have a cleaner business to go forward next quarter. At least I think from how they try to close this deal just before the end of the quarter, it makes me think that they're finally throwing it all in here and moving on. And they've lost a shit ton of money between this and the Apple Cards business. I think they lost multiple billions. So this has been one ugly period for Goldman the last few quarters.
I always thought it funny when I kept reading the stats that the biggest users of the Apple Card were subprime.
Isn't that weird though? It's so counterintuitive. You think typical Apple buyer profile is pretty clean, prime credit. So that was a revelation when they lost that 800 million or so like 3 quarters ago.
Well, I mean, it almost doesn't matter whether it's subprime or not. The place you don't want to be is like the third card in the wallet, credit card, right? Because you want to be the front of the wallet, right? No matter whether you're subprime or prime or super prime, right? The problem if you're the third card is you're hardly ever used, and you sort of don't get a lot of interchange fees from purchases, but you get the lion's share of the losses, because typically people don't start using their third card until the first two are full, right?
Yeah, that's an interesting way of looking at it, Bill. Yeah, I never thought of it that way. Yeah.
it's also funny because in most of the deals like which Goldman is notorious for doing, like if you look at with Malaysia or what they did with Greece, they are on the other side of the game. Like they would do things like where their clients would lose money. So here, like it's like Apple defeated them. It is like, yeah.
Did anybody catch that? It came in muffled clean.
Sorry, Paul, can you come again? I didn't hear you.
No, I didn't know if anybody heard that. It was like muffled for me for some reason. Or maybe my muffled? Is my speaker
Yeah,
off?
it's a little bit scratchy. We had that.
Okay.
So Nate brought up another thing. We were talking in different spaces, about VMware suddenly starting to move. And he and I were exchanging DMs, and my thought is, maybe that deal is closer to closing, or maybe the risk of it not closing is getting lower. Even if marginally. So that's another thing, right? There's still I think a good percentage of merger arb there left in, primarily because Avago ran up during the Broadcom ran up during that time. So that's another interesting one. What else?
You still got the ARB for iRobot and Amazon.
Yeah. I still think they walk away from that deal at some point. I'm not sure. I don't have a position on that one. So
I don't know though, because like they already revised the deal and they revised it down. Shareholders accepted like yesterday. So it's like, I mean,
Okay.
we're just waiting for the FTC to basically say yes or
Okay.
no.
I've not been following, so I'm sure you're right. So
Yeah, I mean, the spread's pretty juicy right now. And on top of that, you have the other one. Sorry, 'cause I'm so like consumer focused. You also have Kroger's and Albertsons, which has had its own roller coaster since last year. Um, but I believe they're making headway with union issues, location issues, um, like some of the divesting stores, etc. So that's another spread that is interesting to watch.
talking about deals, right? So day before yesterday, Atlassian, which is ticker TEAM, they acquired a company called Loom, which is some video software that I don't know what they do, video messaging provider, for $1 billion. And interestingly enough, most of that was cash. So
Oh no! It wasn't a billion. It was 975. It was like a nice like fuck you to like not round them up to a unicorn.
yeah, and most of it was cash. So that's the part that I was anchoring on, is like, okay, you know what? Companies, even the companies being bought, realize that, hey, there is a risk out there if things do turn around, and by the time the deal closes, they're going to be worth far less. So might as well just make them pay up and pay cash, even if it's a little bit less that negotiating power you have. So
Well, because I think the last valuation round was at 1.5. Maybe it was a little bit above 1.5. So cashing in at under one, you still had a pretty good haircut for the last funding round.
I mean, still getting close to, or 880 million, it looks like, cash from team at this point, at this near the peak of this cycle, if that turns out to be, the case, is still a good exit for them, given it's all cash, and or almost all cash, right? 5%, 6% of it is not cash at this point. So that's interesting. Maybe we have to see if this is a path for other companies, right? I mean, this is not the first one, right? Splunk was all cash, so you're seeing more of this. So companies have to pony up to buy. So it's going to be interesting to see what that does to the M&A cycle.
Wasn't Twinkie also all cash?
I don't follow, so I don't know.
Yeah, I'm gonna pull it up just so I don't misquote it. But yeah, it was the guys who make Twinkies. Who's it, Hostess?
Let me also pull it up while you're doing that.
Yeah, here we go. It's Smucker's buys Twinkies maker Hostess for 5.6 billion.
It says cash and stock.
I'm pretty sure this is all cash. Oh yeah, you're right. Oh yeah, but the stock is a joke. What fucking like 0.03 shares? Like really?
It's going to be interesting when VMware closes. Michael Dell becomes the second largest shareholder in VMware outside of the funds. So leave that alone. But second largest individual shareholder after the CEO, and well, him and Silver Lake are going to probably together, if you count them as a very well connected entity, probably going to be close to the largest shareholders in the expanded Broadcom, if you will. And it's going to be interesting how it plays out, because Broadcom obviously has a play in AI with their networking side of it, and they do produce chipsets for Google, Meta, and a couple of others actually. Um, the AI, the custom ASICs for these guys. So it's going to be interesting to see, whether they use that to leverage what Dell can do um, with Broadcom in AI. Sort of like a larger version of SMCI, right? If you will, SMCI has been talking only AI these days, right? It's nothing more than a custom server builder. It's all it is. It's not a semiconductor company. It's not an AI company. They build a lot of these custom servers for that take in a lot of these GPU boards, and they integrate the network and all that stuff. So outside of NVIDIA, this broadens out the ecosystem that 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 Broadcom has access to. If you take Dell into that picture, right? So NVIDIA, one of the advantages they have is that Mellanox gives them the networking, and they can sell that whole package. Of course, they have the software too. So it'll be interesting to see what AMD does when they actually release their, what is that, a 3100, whatever the heck it is. It's starting to come out into the market, but not in larger quantities. So but their software suite is weak, and networking, Broadcom has a better solution than anything they can provide. So it's going to be interesting. It's just something I'm watching out of curiosity. I don't have positions in Avago, though. If it does flush, that's something I'm willing to acquire. Dell is already near all-time high, or near a recent high, if nothing else. So I'm not going to touch that one. But you're valuing PC market pretty close to nothing these days, right? There's no growth. There's been no growth for a while. So anything that improves the situation, Dell would get really interesting. So we have to see. Just talking in my mind. That's all. Nothing. I don't have positions.
Yeah, but wasn't there a call for a replacement cycle because of all the COVID demand?
Yeah, that's my point, right? We're bracing for really, still negative or zero growth in PCs. Data center is certainly weakening, but how much more fall does the PC demand cycle take? If we are near the end of that, then all of these companies could have a nice boost to earnings, or certainly guidance. So it remains to be seen. I don't know. I'm not betting on it yet, but out of the guidance, it might be some interesting plays there. Now, of course, Berkshire dumped HPQ, the enterprise side of it. So I'm not quite sure what was that about, or at least they're in the process of getting rid of their entire holding there fast. So I'm not quite sure what's going on there.
Monitoring, like sometimes it's surprising to see like how much time market is ready to give to these semiconductor players, because it has been how many like earnings, except for Nvidia, if you take it out, or other specific semiconductors, like their earnings have been like best flat. If even Samsung reported this week, no, it was Samsung.
No, I'm not seeing Samsung. I think smaller ones have reported. We have TSM and ASML next week, so that's a big week coming up. But okay, set aside TSM for a second. It is among the lower margin business within within different parts of semi. Probably memory is worse, but ASML and the entire semi cap side of it, right? Those, remember, they have the buffer of a deep order book, right? So they can weather this. Where it's going to be weakness there is mostly in bookings versus shipping, and in guidance to an extent. but it really doesn't impact their sales because they're booked out. I mean, ASML had to, back in early 2022, they literally stopped accepting orders for their UVs because they just didn't want to take on, more than they needed they had orders for 3 years. And at that time, either Q4 of 21 earnings call or the Q1 of 22 earnings call, they said that they have order visibility from their customers all the way to 2027. So, that's the length of the buffer that these guys have built. So I still like, on weakness, right? On any sell off, I think among the semi caps have the most ability to bounce back quickly. And this is just my own take, right? Leave aside Nvidia, like you said, that's a very unique, market situation that they're dealing with. But you're right, there's quite a, I mean, look, Avago is not that expensive, right, relative to, others multiples. So question is, what does AMD do? And I've been pretty open about my feelings about AMD and a few others, right? A lot of them have, Skyworks, Qorvo, all of these guys are big Apple suppliers. So if Apple shows weakness, these guys are all going to faint. And AMD is betting a lot on their new AI chip getting enough volume this year itself, this quarter, right? Q4. I don't think they're going to pull it off. Their guidance when they announced Q2, their guidance for Q3 for data center was flat, and Q4 was going to be a big jump given they would have their product in volume. My own personal thesis, which is why I do not have a position in AMD, is that ramp is going to come more in Q1 rather than Q4, and they're probably at a big risk of missing their data centers numbers for the entire year, not this quarter. It was flat guidance. But that's my own thesis, is that they're at a risk of missing the guidance for data center for the year, right? If they are just, when you see their guidance, it'll tell you, unless they've started shipping it, to their first customers in pretty big volume. They've been shipping it around, and they said that they've heard back positive reviews from the customers. So the question now is, when did they get to full volume, and how long of this quarter do they have to ship in full volume? Right, there's going to always be a customer for a much lower, hopefully much lower price solution compared to H100. So they have that market, but it's a matter of how many days of this cycle do they have that market for, and if they push it out to later than earlier, then the Q4 is not going to be good. That's my own personal take. I'm not suggesting anybody invest in that, but that's my take.
But another thing is like, uh, recently you had TCS. You talked about it in other spaces. You had TCS, Infosys. I think even Accenture reported, and they saw weakness. The stocks were like gap down. So I think the narrative from what analysts are saying from pure tech companies like Google's or even AWS or Nvidia or Microsoft is not the same narrative you're getting from these integrators, which are I would imagine they are much closer to customer.
Well,
The
so think about this for a second, right? So a lot of what these Infosys majors do, right? That's Infosys, HCL, TCS, Accenture, a whole bunch of others. Wipro's already also announced, is they have large staff that execute major programs in different companies, including in tech sector. They did say that their financial verticals are doing better, but their tech verticals are weak, which makes sense because all of these companies are, not hiring, and certainly till a quarter ago they were significantly cutting staff. and it stands to reason that they'll cut the contractors before they cut, employees, which is, there's also some legal requirements to do that in certain states. So that makes sense. I wouldn't read more than that into it. They do, I mean, you have to assume that there is significant cost cutting still in place in tech. So part of, part of that read through you can easily make. Whether it shows actual weakness in tech, I think that's case by case. Maybe within the vertical exposure of tech, you could see that. But again, for me, I still like the larger tech which have the ability to close the deals rather than smaller tech which probably is going to bear the brunt of delays in closing. That's my take. That's how I would read it. I don't have. I mean, the other interesting thing, Baron, is if you saw TCS and Accenture specifically called out that AI uptake is there, but it's ramping slower than than they would have liked, and they're saying it's more a 24 story than a 23. So read what you will from that, but that's more interesting to me.
Yeah, so exactly that point about AI. So I don't know, like all these Indians like system integrators do like high mark. Yeah, some of them they do have part of like high margin product, but I think Accenture is the one which has like in terms of IT consulting companies that has like high margin product, which would be the first to get contracts for implementation of high margin AI products, and even them they are not seeing too much demand. That is my understanding is.
Well, 218 million last quarter is not small. I was actually shocked, but they definitely called out. They said that they don't expect a significant accretive business beyond what they are, they're growing at for from AI, and they said generative AI is going to be far bigger as we get into 24. So that was interesting, and TCS sort of reaffirmed that. I didn't read through Wipro or Infosys. I will over the weekend to see what they said, but yeah, it does look like there is definitely weakness around large program in tech sector. So that they called out all of them. So you have to assume that there's no tech hiring for any immediate future, right? The next couple of quarters is probably going to be very weak.
Another point, Monitor, is like first time like all these like big tech, Microsoft and Meta, like you can literally their capex is like more than 70 billion or something like that. Even Microsoft is right now their spend on these AI chips H100s. Don't you think like long term, because software earlier it used to be just the cost of developers and programmers, and now it is going to be the hardware that is going to be the biggest cost center and the data center build out. So long term they are going to lose on margins.
Well, first of all, Rod, I have to apologize. I don't mean to be taking over your space. I'm really sorry for doing this, but
No, it's
he and
okay.
I have talked multiple times about Microsoft's expectations around revenue ramp from AI, the timing of that rather than the reality of that. So again, I think Microsoft is possibly one of those that is going to negatively surprise in terms of how quickly they are expecting AI revenue. I think it's a 24 story, not a 23 story. Whatever the ramp is, it's going to be I mean, look, Microsoft is a massive company, and they've been talking big numbers. They talked about getting to 10 billion business very short time, and doubling their revenue by 2030, driven by or led by AI capabilities. That's a 16-17% compound annual growth. I think, unfortunately, for people, that's going to be back-ended more than front-ended, right? So you're going to see that ramp get faster and faster as we go in time. But the stock has added 700-800 billion with the expectation that AI is going to make a difference. Is it going to make a difference now? I think that's the negative I have. At least that's the best way I can put it, Baron.
Hello, I'm the AI
Just
expert.
timing. It's 6 at the top of the hour. I have family coming over. I'll let us run this another 15 minutes before shutting it down. Just FYI.
Okay. I just wanted to see monetize what your best use case for AI is.
Use case?
Yeah, like what are you going to use it for yourself?
Well, I go find, ask it to analyze all my, company earnings reports, and then I go check it because I don't trust it yet.
Yeah, I was on a ChatGPT like a couple of days ago, and I'm asking it, it's got total access to all the literature in the world, and I say, create a timeline for the story of like the Apollo miss, and it was so ridiculously wrong. It wasn't even funny. Like it was like I was shocked at how bad it was. So I think it's got a long way to go before I'd be using it for finance or anything in the medical field or anything like that.
That's the point I'm trying to make. I think the revenue ramp is going to be slower than people expect. That's exactly what I'm trying to say. Look, it's coming. I don't for a second say that, claim that AI is not, I mean, it's not going to be accretive to revenue. I think you're going to see more in terms of efficiencies, things like that show up. But again, those are sort of things that come over time. It's not the $30 a month that Microsoft was trying to claim for their product with 300 million users. That would make it that, what, 10 billion? Is that how the calculation was? I think that's where I question the timing of it. Maybe it'll get there eventually, but not in not in any not in the next 3-4 quarters. And certainly you saw um, Adobe, which reported very late in the cycle, right? They just reported, what was it, end of September, something like that. They called out too. They said, and this came up multiple times by multiple analysts. They are not seeing any massive revenue ramp this year, and they are expecting it to slowly start building on itself and have something significant next year. But it's not happening now. So I think you're going to hear the same from more and more companies. Right now we're still in the build out phase. As far as making money out of it, we're still some ways off.
Yeah, I think basically what AI is right now, it's Google Search 2.0. It's not changing the world. I could find the same information from Google Search on Wikipedia, but when I did ask it, I said come up with 100 myths about Apollo first to preempt it to then organize them by timeline, and it was like I can come up with 10. So I was like, okay, now come up with another 10, another 10. I did 10 times, and then it had 100, and then I said now organize them in order of a timeline. So what it did great was coming up with the stories and making the list, even though it wouldn't do the full list at once. But then when it came to the timeline, it was like, I mean, if you know anything about Greek mythology, there's the story of the Python, and then there's the story of Apollo becomes the god of the Pythian oracle, and then but it had put one at the beginning and one at the end, and I was like, why would you put them so far apart? Why don't you put one right after the other? And it was like, yeah, you're right. I have no idea. So I think when you call it intelligence, at this point it's more search engine. But pizza's here for me, so that's all for me tonight. But I'll tune in Wednesday. Bye.
Nice
I
hand
just
from you
wanted to
before.
jump in on the graphic card discussion. Like as far as graphics go, I'm a system admin, system engineer as a professional, and when it comes down to graphics card, I think the AI thing is getting a little blown out of proportion. I think people need to kind of understand where video cards step into server roles, and it's a big thing in VDI and streaming and whatnot like that. So I think the whole acquisition with VMware, Broadcom, Dell is actually going to end up being some kind of monopoly, if you will, whereas Dell is providing the hardware, or I guess the skeleton. Broadcom's got the chipsets, got the network cards, and then VMware is going to be running all the server hypervisors on top of everything. And then you have NVIDIA, who runs the video cards that is required for VDI to even scale. And these cards are not cheap, and their licensing is not cheap, and it's on a yearly basis. And then with the whole thing with Microsoft trying to push Windows to basically desktops as a service or Windows as a service, I think you're going to start seeing more and more of these big giant companies more or less hosting everybody's stuff, and you're not going to be able to get away from it. And whether it be a giant IT consulting company that's running these servers or whatever it may be, I think that Dell is going to jump into that managed service provider space, as they already are, and being the ones that host this stuff. So if you think about it in that scale, Dell, VMware, Broadcom, Microsoft all can scale very hugely in a very short amount of time in the next 5 years or so.
Yeah, I don't know about how Microsoft fits in. Obviously, they're one of the largest partners for Dell, but I agree there. But yeah, I mean the rest of it, yeah, there is a lot of synergies, and Hawk 10 is a rock star in squeezing costs out of sort of, let's say, businesses that are getting more mature. So there's going to be some. He's already talked about his plans for cuts in VMware, and where he's going to continue to spend and where he's going to cut back, and staff reductions, all that. So VMware is better off, at least in my opinion, based on history. I know that in the hands of somebody like Hawktan, and the process they have in place to manage costs and manage R&D carefully, than it is as a company by itself, which is not done all that great. The growth has sort of been meh for better part of 2 years now, or a year and a half at least. So I think this is gonna be a good deal, all said and done. But I'm gonna stop right there, Bob. I want to give time for Rod to close it out, so I apologize. I'm just gonna stop right there.
It's good stuff. I love hearing about it because it's not a space I follow. So thank you everyone who does know the space for sharing your thoughts and insights into it. And that's the whole purpose, hopefully, of these sorts of conversations, to hear insights and knowledge shared from people who have different domains of expertise than we do. So I am gonna wrap it. Been on the phone all afternoon, and I feel like I'm gonna pass out if I don't get some food in me. So thank you very much, everybody, for tuning in. Just as a kind of programming recap, we do these calls at the close on Fridays from 4 till about 6 or so Eastern, usually. Joe puts out a little newsletter with some of the stories that we're going to talk about. We spend 20, 30 so minutes talking about that, and then we open it up to whatever people want to touch on, which we've been doing this afternoon. Joe, we also have the Wednesday night call and the book club if you want to wrap up and take us out.
Yeah, so we do our Wednesday night call over on @GMEDD. It's a bit of an open mic, so less of a structure. Anyone wants to talk about any topics, bring them up. Want to pitch a stock, you're more than welcome. It's a fun one. We've had a pretty big turnout over there on the @GMEDD account. So if you want a conversation with more and more speakers, tune in over there. We also do the book club. So we host the Wook Book Club every month. This month it'll be on The Little Book That Builds Wealth by Pat Dorsey It'll be discussed on November 14th over on the Discord server. So join in on wook.gg. Link will be on our Spaces title here. Just put that into your browser. You can join in and talk about the book with us. So if you haven't read it, you got more than enough time. Even if the time comes, you're more than welcome to join in on the discussion, learn a little bit about the book if you haven't read it. So thank you, everyone, for tuning into our space. Hopefully we see you again on Wednesday.
All right. Thanks again, Monative, Bill, Baron, Bob, everyone who chimed in on the panel. Appreciate it, everybody. And for those of you who tuned in, hope everyone has a nice rest of their day and a pleasant weekend. And genuinely mean it. Stay safe out there. Cheers, everyone.